Are you seeing the news on the financial crisis and making plans to run to the bank to withdraw all your cash? Watch to the end of this video to realize why that may be a terrible idea. Hey guys, welcome back to this episode of Living and Buying in Charlotte, North Carolina. I'm Keith Porter, and I appreciate you taking the time. If this is your first time with us, go ahead and like the video and subscribe to the channel. That way you'll get notifications whenever a new piece of content comes up. All right, moving on with our financial crisis. This recent banking crisis has created a lot of attention and fear-mongering in the last week. Many people are sounding alarms to anyone who will listen that we are approaching the same crisis we saw in 2008, and this is not the case. Bank failures have been a common occurrence throughout history, often causing ripples throughout the economy. The 2008 financial crisis, which saw a large number of banks fail, is still fresh in the minds of many homeowners and investors. The collapse of banks can have a significant impact on the housing market. One of the primary ways that banks influence the housing market is through their role in real estate lending. Banks provide loans to individuals and businesses for property purchases, which fuels the housing market. When banks fail, there is often a reduction in lending, which can slow down the housing market. The impact of bank failures on the housing market can be seen in the 2008 financial crisis. Many banks failed, and there was a significant reduction in lending. This caused the housing market to crash, and many homeowners found themselves underwater on their mortgages. The resulting foreclosures caused a glut of homes on the market, further depressing prices. Though this is already the second largest banking failure in American history, it is important to note that these individual bank failures are unlikely to cause a widespread crash like the one that occurred in the 2008 financial crisis. The reason for the failure is due more to human error than market conditions. Two banks, Silicon Valley Bank, SVB, and Silvergate, collapsed for radically different reasons within 48 hours. Silvergate failed due to taking deposits and investing in cryptocurrencies. As cryptocurrency values fell, they didn't have the liquidity to pay depositors as they withdrew their money. On the other hand, SVB invested in U.S. Treasuries, which are considered a safe asset, but their maturities mismatched their deposits. SVB bought longer-term Treasuries, leading to declining bond prices as yields rose. Furthermore, as rates increased, speculative investments in startups declined, leading to young companies withdrawing funds for payroll and operating expenses. The SVB failure was a classic bank run where a few got nervous about SVB and rapidly withdrew their funds, while SVB assets had declined due to rising yields and lack of liquidity. Both failures are classic errors that regulators should have caught. The regulators are always focusing on the last crisis rather than evaluating how much the economy has changed. Investing in cryptocurrencies should not have been allowed by an FDIC-insured bank, as these are not marketable securities. There are several reasons why the recent events, such as the failures of Silicon Valley Bank and Silvergate, are unlikely to cause a crash like the one that occurred in the 2008 financial crisis. Firstly, the current real estate market is fundamentally different from the market in 2008. Prior to the 2008 crash, there was an oversupply of homes and an increasing number of homeowners who were unable to make their mortgage payments. This led to a large number of foreclosures, which further exacerbated the oversupply issue. Today, the market is characterized by a shortage of homes, which has resulted in increasing prices and competition among buyers. Additionally, mortgage lending standards have become stricter since the financial crisis, which has resulted in fewer risky loans being issued. Secondly, the financial system has also undergone significant reforms since the 2008 crisis. Regulators have implemented new rules and regulations that have made the banking system more resilient and less prone to collapse. For example, banks are now required to hold more capital as a cushion against potential losses, and the Federal Reserve has established mechanisms to provide liquidity to the market during times of stress. Lastly, recent events such as the failures of Silicon Valley Bank and Silvergate are relatively isolated incidents that are unlikely to have a significant impact on the broader real estate market. While these events may result in some short-term disruptions or market volatility, they are unlikely to trigger a broader collapse. Overall, while there are always risks and uncertainties in any market, The current real estate market is fundamentally different from the market that existed prior to the 2008 financial crisis, and the financial system has become more resilient and better equipped to weather potential shocks. Therefore, it is unlikely that the recent events, such as the failures of Silicon Valley Bank and Silvergate, will cause a crash like the one that occurred in 2008. But let's look at the ways that this crisis may affect the housing market for the time being. Number one, declining consumer sentiment will likely reduce homebuyer demand. One of the first-order impacts of a banking crisis will be a negative impact on consumer sentiment. Even with the government bailout of SVB depositors, I suspect many Americans are still rattled by the second biggest bank failure in U.S. history. As a result, base instincts for many will be to cut back on extraneous expenses, save more money, maybe hold more cash and gold, and to probably delay that decision of taking out a mortgage at 6.5% to buy a house at near all-time high prices. This negative sentiment will be a problem for the housing market because homebuyer sentiment is already at the lowest levels of all time. The most recent Fannie Mae housing survey showed 79% of Americans thought it was a bad idea to buy a house in February 2023. The lesson here is that fear will lead us into a self-fulfilling prophecy in terms of the housing market. If we let fear hold us back from purchasing homes, we will in fact be causing the very thing we are afraid of. Number two, mortgage rates could go lower. Could go lower. Could. In fact, mortgage rates have already gone lower. According to Mortgage News Daily, the 30-year fixed dropped from 7.1% last week to 6.5% today. One of the biggest short-term drops ever. Mortgage rates are dropping because long-term bond yields are plummeting. Long-term bond yields are plummeting because there is a lot of fear in the market right now. If the banking crisis worsens and spreads to other banks, it's likely that mortgage rates yields will continue to fall. And that recession everyone has been talking about the last 9 months will loudly announce its arrival. Will falling mortgage rates act to stimulate the housing market? Maybe. But they'll need to go a lot lower than 6.5% for that to happen with the recession in the distance. Number three, the next move belongs to the Fed. The Fed is between a rock and a hard place right now. On one hand, they're trying to fight inflation by hiking interest rates and reducing the money supply. But on the other hand, they're now tasked with ensuring the banking system itself doesn't collapse. Before the banking fall last week, many experts were speculating that the Fed would be increasing interest rates between 25 and 50 basis points when they meet next week on March 22nd. For now, that seems to be up in the air. Some are now speculating that the Fed may lower interest rates minimally to help with consumer confidence, while others point to the need to increase, though not as much, to continue targeting inflation. It is uncertain what will happen until after hearing from the Fed next week. For now, my advice would be to refrain from going out and causing a run on your local banks. Take some time to reflect and be patient. Wait a couple weeks to see what happens in the market and make a decision with as much information as possible. In the meantime, speak to some banking specialists. They would have access to far more information and tools to track the metrics than I have at my disposal. What are your thoughts on the crisis? Do you think we'll have rates increase or decrease? Leave a message in the comments. And if you haven't already done so, subscribe to my channel and leave a like on this video if you want more content like this. Until next time, thank you for joining us on Living and Buying in Charlotte, North Carolina.